Okay, sometimes traders spend vast amounts of time and effort to improve when a simple tweak is all they really need to hugely improve their results. In this video, we'll teach you an incredibly simple way to increase your options trading income by more than 50% with a minor counterintuitive tweak that most traders don't even think of. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Froyberg, and I'm the head trader of S&B Capital's options trading desk here in Manhattan. And traders are always looking for edges to capitalize on. In today's video, we're going to be teaching you an incredibly simple way to take a trading idea you have and express it using option strategies in a way that's far more optimal than most traders would have naturally thought of on their own, because the tweak we'll be sharing with you today is counterintuitive. Okay, so as an example, let's head back to July 12th, just a few weeks ago. And as you can see, since March, the SPX index has been on an incredible run, up over 17%, a 670-point rally in a little under 4 months. And so, as the old saying goes, the trend is your friend. And most traders would take this to be a pretty bullish chart. And so, with the index opening at 4478.25 that day, suppose that a trader decided to make a bullish trade on the SPX index over the next week. And so the trader has chosen a particular option strategy, which involves the use of index options, naturally, because this is, after all, a bet on the entire S&P 500 index, which trades under the symbol of SPX. So in order to explain how the strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. So just hang in there. The best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 4032, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 4075 call would expire worthless, as the index didn't close above 4075. So the call seller just pockets the premium, and the puts are just the opposite. If the market closed at 4032, then the 4075 put would be worth $4,300 because the market closed 43 points below the put strike price of 4075. But the 4,000 puts, those would expire worthless because the market didn't close below the 4,000 strike price. With that said, let's return to the morning of July 12th, where let's say you decided to make that bullish trade using index options. So let's say that on that morning, the trader pulled up an options chain that expired 7 days later on July 19th and went ahead and sold 10 of the 4475 puts, which, as you can see, were priced at 2270, and then simultaneously bought 10 put options at 4425, 4855. Well, when he sells puts higher on an options chain and buys puts lower on that same options chain, that is referred to by options traders as a put credit spread. And in this case, we've set up what's known as a 50-wide put credit spread because the strike price separation between the short and long options is 50 points. And put credit spreads are bullish trades, as you're going to see in a minute. Let's first examine what happened here from a cash flow standpoint. And as you can see, selling those 10 puts at 4475 at a price of 2270 yielded $22,700. And that's because each put option on an index pays off at $100 per point. So you multiply the price by 100 and you sold 10 of them. And so you multiply that by 10 and you get 22.7. And using that same logic, the 44.25 puts cost you 85.50, which results in a net positive cash flow of 14,150, which flows right into your account. Now, you can also see that we've stated that your broker will require 35,850 in capital in your account for this trade. Now, we need to drill down on exactly why that is, because it's important for you to understand. So let's say that hypothetically, the index were to close at 4,400 on the day the put credit spread expired. Well, in that case, then you would take a loss on the trade. And why is that? Well, we'll first start with remembering that we initially received 14,150 for selling the put credit spread. So that's a positive. But then the 44.75 put we sold would pay off $100 per point for every point below 44.75, which, as you can see, is 75 points. And we sold 10 of them. So the total loss on those would be $75,000. However, remember, we've got those 44.25 puts, which are 25 points above the closing price. So they pay us $25,000, as you can see, using the same logic. So when you net down the original cash we got for selling the put credit spreads and factor in the payoff of the two put positions, the net loss is 35,850. And in fact, at any price below a close of 44.25, the loss would be that same 35.80, because once the price gets below 44.25, then the 44.25 puts begin to act as protection. And those puts start increasing in value at the exact same pace as the payout is increasing on the 44.75 puts that we sold. So we start getting reimbursed dollar for dollar at any price below 44.25 by the puts we bought. And so they effectively act as a built-in perfect stop on the trade, if you think about it, and it freezes the loss at 35,850, no matter how low the index price goes. And so the worst that the loss can get is a closing price of 44.25 or below, and it doesn't matter how much farther below, because the long puts act as this ironclad protection below that. And now you can see why we say that your broker will require you to have 35,850 in your account, because you have to have that amount in your account to cover a potential of a maximum loss. Okay, so let's now move to the close on July 19th, the day these options expired. And as you can see, SPX index closed at 45.65.72, having rallied about 90 points from the entry day of the put credit spread a week earlier. And so now let's look at the results of the trade. And as you can see, it's a pretty straightforward calculation, because after adding in the original credit we received, there's nothing else to calculate. The index closed well above the 44.75 short puts, as well as the 44.25 long puts. And so the only thing that happens upon expiration is that the trader pockets that initial 14,150 in cash as profit. And the puts just die and go to options heaven. And that's the best case scenario on this trade. You just pocket the cash, which results in a maximum win, which is the initial cash received. That's the most you can make. But let's consider another possible way that this could have been played. Let's suppose that we go back to July 12th, but this time, instead of executing that first put credit spread that we just demonstrated, what if we executed a different put credit spread? Short the same strike as we were before, the 44.75, but long the 44.50 this time, only 25 points away. And suppose that instead of selling 10 of the put credit spreads, we sold 21 of them. Well, let's take a look at the new trade's cash flow. And as you can see, the 21 short puts brought in $47,760, and the 21 long puts cost us $29,505, which nets down to positive cash flow of $18,165. But this time, our broker is only going to require us to put up $34,335 in our account, a little less than on the previous trade. Now, to understand why, let's take a look at that same worksheet we used for the 50Y spread in the previous example. And as you can see this time, if the market were to close at 4,400, just like before, we'd have a lesser loss, a loss of 34,335. And again, that's because at any closing price below 44.50 in this case, the 44.50 puts that we bought act as a perfect stop on the trade, again, reimbursing us dollar for dollar as the loss created by the 44.75 short puts is offset perfectly by the gain in the value of the 44.50 long puts. And so the maximum loss never gets larger than 34,335. And so when we calculate how this 25 wide put credit spread trade would have come out, you can see that it's very similar to the 50 wide trade in that we start with the initial larger positive cash flow of 18,165. And then again, the two sets of puts both expire worthless because the index closed way above both of them, resulting in a full win of 18,165 on a slightly lesser risk exposure, an incredible jump in the return on the trade of up over 52% from the original 39% of the 50 wide trade. Let's take a look at yet another trade we could have done, and that is an even tighter spread. This time only 5 wide, but this time we're going to be selling 110 of these put credit spreads. And so amazingly enough, again, we sell way more spreads with tighter build-in stops. Yet the amount of capital that we need for the trade, which we've now shown you is synonymous with the maximum loss of the trade, is even less at 33,000. If you go through the calculation we showed you in the previous two cases, you'll see that the effect of the stock being located only 5 points away prevents any loss from getting any larger than $33,000, even though we've sold an incredible 110 of these put credit spreads. And so when you look at the outcome, it's even more incredible with the cash return going up again, this time to 22,000 on lower risk of 33,000 for a 66% return of capital, the lowest capital level yet. And so to summarize the results of this comparison, you can see that it's no contest. As the spread between the short options and long options gets tighter, you sell more lots without using any more capital. In fact, using less capital while producing more cash and more return. And so what I'd like you to take away from today's video is that sometimes the counterintuitive choice is in fact the best choice. In this case, it's counterintuitive for a trader to consider that the more you spend on your long put protection, the better your outcome will be. You'd think that you'd want to minimize the cost of your protection, but in fact, with credit spreads, the closest long strikes to the short strike you're selling is almost always going to be the one that provides you with the best return at the same time. Higher returns and less risk. I mean, what's not to like? So these are the kinds of trade-offs that professional options traders are always on the hunt for. And if you begin to incorporate these kinds of edges into your trading, you're going to become a stronger and more professional trader over time.
Okay, now that you've learned this simple tweak, you might be interested to discover how you can make weekly income from options trading. Learn to do it the right way by clicking on the video appearing on your screen right now. Hopefully this helps you grow your trading account.